Welcome to the Debit This, Credit That podcast with Wheeler Accountants located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Hello, this is Matt Hallern again, joined by Matt Wheeler. Last time we talked about the choice of entity when it came to sole owners or sole proprietors. And what we're going to dive into today is something a little bit more, well, it's a lot more in depth actually. We're going to talk about what it means to have multiple owners in a business and how that can affect you really from a legal entity standpoint and from a taxation standpoint. Did I miss anything there, Matt?
You got it.
All right, brother. Well, let's dive right in. Tell our listeners, what do you mean by multiple owners?
So multiple owners is going to be any sort of legal entity where we have basically more than one owner structure. So last time we talked about, the various legal structures you can have when you're the sole owner of your business. We had, sole proprietorship, which is no legal structure put in place. We have LLC, but it was a single member LLC, which has some special rules surrounding that. And then we had a regular corporation and an S corporation, all of which can be just one owner. So today we're going to talk about entities with more than one owner. So that gets rid of the sole proprietorship because that's by definition a single owner. But we still have LLCs or partnerships. LLCs can be taxed as a partnership, generally speaking, by default. And then we have corporations, both the C corporation and the S corporation.
All right. Well, this is one of those things I'm going to start right out of the gate by reminding our audience that this stuff is really, really deep. And if you haven't had a great and in-depth conversation about how you need to form your legal entity for your business, please talk to your accountant, because this stuff gets very confusing very fast. And if you don't have somebody like Wheeler in your corner, then, you can really miss stuff. I learned so much on that last one, being a sole proprietor myself, and now I understand why my CPA did what my CPA did. So, Matt, I really appreciate that education last time. But let's jump into partnerships. So let's launch right in. What is a partnership and what are the advantages?
Matt, you brought up a really good point we just talked about. And thank you that you really got to consult our firm or someone at our firm or your accountant before you make a choice of entity, because undoing it can often be costly and a lot of work. And, you don't want to go down the wrong path to begin with. Each situation is totally different, and the fact pattern that you have is going to be different, and there's going to be pros and cons to each entity type. And we're going to try and go over those today. But I just want to make it perfectly clear that this requires some discussion up front, some in-depth planning to really understand what your needs are, what your business is going to look like initially and in the future to determine the best entity choice for you.
Right. All right. So you've decided after your lengthy, introduction and discovery process that you guys have, you find out that they want to do a partnership. Why would somebody have and decide to file as a partnership?
So a partnership's a great structure. It's any entity or let me put it this way, the IRS has some default rules they classify entities under based on the facts and circumstances. So if, you and I meet for coffee one day, Matt, and we have this great idea and we decide we're going to, build a who what gizmo widget and sell those and make a ton of money, and we do a handshake deal, it's going to be 50-50 and we're off on our way. We formed a partnership right there, according to the IRS rules. So you don't need a written agreement for a partnership, although we highly recommend one. It's one of the easiest structures to put in place, and it's basically the default classification when you have more than one person in business together to start business.
All right, fantastic. Well, what are the advantages of it? I mean, besides the fact that it's easy and it's really just like a handshake deal, or it can be, what are the other benefits of having a partnership? A
partnership is going to be what we call a pass-through entity or flow-through. So all of the business activity that's taking place in the partnership, all the income earned, all the expenses and deductions incurred, and the net income or loss, the partnership is not going to pay any of its own tax on that, generally speaking. So that's all that activity is going to be reported on a partnership tax return, but then each partner is going to get what's called a K-1 form that's going to show their share of the profits or losses of the partnership, and then they're going to report that information on their personal tax return. So that's one of the advantages of a partnership is there's no separate layer of tax at the partnership level, and we'll get into what double taxation means later when we talk about C corporations.
Okay.
But with a partnership, you have flow-through treatment, so everything kind of ends up on your personal return. You're taxed at your personal tax rates, and you don't have to have these extra layers of tax between you and the business.
Okay. What about losses? So you start up the widget business, and there are some incurred losses right at the beginning. How does that affect the partnership, or how does that affect who gets what and what goes where?
A float-through entity or a pass-through like a partnership is great when you're going to have a business where you're expecting some initial startup losses as you kind of get ramped up in business. And that's pretty common really in most businesses. You'll have, some businesses that make money right off the bat or just pure profit businesses like consulting or service type businesses. But, a lot of businesses, if they're capital intensive or kind of have a ramp up phase to get your product out there and start gaining traction with customers, you're probably going to have some losses in the beginning. And, if you have a lot of other sources of income on your personal return, the flow-through entity is great because those losses can flow down to your personal return, and you can offset that other income with those startup losses. So you're going to end up saving money on tax for what you're investing in this business, and that's why it's designed that way. You're investing in a business, you're starting up, you can take advantage of those losses and offset your other sources of income.
Okay. Well, when you talk about partnership allocation of income and K-1 distributions, how does one figure that stuff out?
So this is where partnerships have the biggest advantage in terms of you can allocate the income more or less how you want. There's some technical rules, obviously, which, they have entire courses on, so we can't talk about them in a 30-minute podcast. But, generally speaking, you can allocate profits and losses how you want in a partnership. There's a lot of flexibility. Now, the downside of that is it can get very complicated very quickly. So you need to make sure that your agreement on how you're allocating losses and income and that sort of thing reflects, the economic realities of the situation, what the partners, want and agree to, but not so complicated that you're, spending thousands and thousands of dollars in accounting fees just to, do these little allocations of income and loss, which may not be material or something,
Mm-hmm.
So, one of the common situations, and you see this a lot like in real estate deals, maybe is you have one partner coming into the partnership is bringing the money,
Mm-hmm.
and you have another partner who's bringing the expertise or something. Maybe they're a developer and they're going to develop the property, that kind of thing. So partnership structures are great for those types of situations, and that's why you'll see a lot of real estate deals structured inside a partnership, because you can put all kinds of provisions in your agreement as how you want to allocate the income. And we call them usually like waterfall type provisions, because it's like, a river flowing, and each waterfall, it splits into, two different rivers, and you can define those splits however you want, right?
Uh-huh.
So you usually will say, right at the top, the money guy gets an X% return on his investment or his or her investment, right? So that's a preferred return. Then we may say that after that, then everybody gets paid back their initial investment they put into the, partnership. Level 2 of the waterfall. Then level 3 might be we're going to split profits 50-50. And then level 4 might be we're going to split them, 70-30 or something to the, in favor of one of the partners kind of deal, if it's like a really profitable deal kind of thing. So you have that flexibility in a partnership. It's fantastic. And those kind of situations aren't super complicated to allocate the income, but, they do complicate things a little bit. You can take a look at a lot of service partnerships like accounting firms,
Mm-hmm.
or other firms where, sometimes they'll have, these big, massive spreadsheets that kind of calculate how each partner is paid on their, provision of services, how big their book of business is, how profitable their book of business is, how many billable hours they're putting in,
Mm-hmm.
What's the change in the size of their book of business, all these kind of things. You can do that, and then you can specially allocate the income according to the results of your, spreadsheet or formula or whatever. So flexibility is key in a partnership, and that's what's really fantastic about them and one of the major advantages you have going the partnership route.
Well, what about transfers of ownership or termination of a partner? Is that really complex when it comes to this, or does this make it easier?
In a partnership, it's relatively easy to change the ownership structure or get assets out of the partnership in a tax-free manner. There's a lot of provisions in the tax code that allow us to do that. So you have a piece of real estate inside the partnership, for instance, and it's worth $5 million now, but you only bought it for $1 million or something. You can take that piece of property out of the LLC, distribute it to the owners, and then, you could do a tenants in common ownership type arrangement on the outside of the partnership, for instance, and sell the property, and one partner may want to do a tax-free exchange into another piece of property. One partner may just want to cash out, that kind of stuff. But you can undo the partnership and take the asset out pretty easily. Transfers of partnership interests can be relatively easy. The accounting on the inside can get complicated on that. But from a tax standpoint, you can get things in and out of the partnership pretty easily, especially compared to the corporate structure.
How do you quantify the sweat equity, though? I hear that often. You just talked about the person with the money and then the developer, even though the developer actually can quantify some of that stuff. But maybe you're really focusing on somebody's expertise and not putting up a lot of money. How do you figure out how to distribute ownership and percentages of ownership to somebody who's not necessarily writing a check?
Good question. I was just dealing with this yesterday, in fact. Have a client who started up a successful business. He wants to reward a couple of his employees with some ownership in the business or some share of the profits. And we were talking about, what's the best way tax-wise to make sure that happens for both the business and for the, employees that will soon be partners. And there's two types of interests that the IRS says that you can have in a partnership. Generally speaking, from a tax standpoint, you can have a profits interest, which means you get a share of the profits or losses of the partnership, but you don't own anything of the underlying capital of the business. Mm-hmm. And then there's a capital interest.
Okay.
And the way they actually define it is a capital interest is, when you have a share of the business that if the business were to liquidate and sell at current value, you would get a piece of that upon the termination of the partnership.
Gotcha.
That's a capital interest, that you have some equity in the business, right? And then a profits interest is just defined as anything other than a capital interest.
Okay.
So when you are talking about giving someone equity in exchange for services, that falls under a specific section of the tax code, code section 83. And the IRS has specific rules regarding what happens when you get a profits interest versus what happens when you get a capital interest. So if you get just a profits interest, the IRS says that's not taxable, assuming you follow a couple of safe harbors and the revenue procedure they have. And that's the route we went yesterday with my client for the employees. They're going to get X percent of the business in terms of profits, but they're not going to get any immediate ownership in the equity. And that kind of makes sense because you're not getting taxed on, you're not really getting any current value, right? Because if you get a profits interest and you're not entitled to any sort of equity upon a sale of the partnership at current values, if they liquidated and sold the day after you got the profit interest, you wouldn't get anything. You didn't get any value, therefore you shouldn't be taxed on that.
Right. Okay.
That makes logical sense.
Yeah.
And that's the route we went, right? A capital interest, if you're going to give a capital interest to somebody, you're giving them a slice of a business that's already worth something. You're giving them value in exchange for the services provided. And so the IRS is going to say, well, that's a taxable event, right? It's the same if you get stock in the business you're working for. That stock has value. You're getting paid that in exchange for doing work. Just like when you get paid cash in exchange for doing work, you receive value. This code section kind of encompasses all that, right? Otherwise, people would use all these different ways to give people value without getting taxed on it. The major disadvantages of the partnership are that the accounting can get really complicated inside the partnership. And I think people oversimplify that initially when they have small partnerships, and they kind of get themselves in trouble down the road by not following the proper accounting over time. Partnership accounting is the most complicated part of the tax code. It's the most complicated, stuff we do when you get a really complicated partnership deals. And it's like that for a reason. There's all these rules to prevent abuses, right? Because if otherwise it'd be really easy to form a partnership with someone. And then if you're in a really high bracket, and you want your kids in a lower income bracket and you want to shift income to their bracket so you pay lower tax overall as a family, for instance, without these anti-abuse rules, it'd be way too easy to just form a partnership and then say, well, now, Junior gets 75% of the profits. I only get 25%. Mm-hmm. And so now he's going to pay tax on that, but really the money is going to be mine still, those kind of funky things. So there's all kinds of rules around how we book the value of assets inside the partnership, adjustments we need to make when partners enter and exit the partnership and multiple partnerships, right? When there's like more than two, mm-hmm. When the business is sold, if you sell or retire part of your interest and there's what's called hot assets inside the partnership. So unrealized receivables, inventory, some of that kind of stuff. The rules just get really complicated in a partnership really easily. If you're going to do a straight 50-50 partnership or something, that's fine. And if it's a simple business and you do treat everything 50-50 as far as distributions and that kind of stuff, then you're good. But if you don't book things correctly, and over time these disparities get bigger and bigger, it's got to get fixed at some point. And, partnerships are a zero-sum game. So in the end, it all nets out to zero, but it can be wildly different between different partners, which can be, favorable or unfavorable to certain people. And if you have a lot of partners in a business and you're not doing the allocations right, you're going to have some upset investors or partners, right? If they're getting allocated more taxable income than they're really supposed to, or vice versa, or less losses or more losses, So mm-hmm. that's probably the major disadvantage I can think of with the partnership. It just gets really complicated really fast.
Okay. Is there anything else that our listeners need to know about forming a partnership before we move on to the next choice of entity, which would be S Corp?
Yeah, and another disadvantage of the partnership is that some of the classic fringe benefits that you get when you're an employee of a business, tax-free health insurance premiums paid on behalf of your employer, little cafeteria plans like a FSA, flexible spending account, and a lot of those little kind of things. When you're an owner, those don't apply to you. So when you're a partner, you don't really get to take advantage of a lot of those things, and you can get penalized a little bit there. The health insurance one ends up kind of working out because you can deduct that on your personal return, but the little bit of accounting trickery we have to do where we, add it to your income, then you deduct it again on your personal return. Mm-hmm. So, just the fringe benefit thing, and that applies to S corporations also, and that's what we're talking about next, right?
Yeah, so let's jump right in. So what is an S Corp, and how do you help people make the decision to see if an S Corp is the right choice of entity for them?
So an S corporation, like we discussed last time, is basically just a regular corporation that's been formed under state law, and then you make a subchapter S election with the IRS to treat the corporation as what we call an S corporation. And the main thing that really accomplishes is it turns what would be otherwise a separate legal taxable entity that pays its own tax, like a C corporation, into a flow-through or pass-through entity, kind of like the partnership. So a lot of those advantages we just discussed, where you can deduct losses in the beginning, where you can, pay tax on your personal return instead of having a second layer of tax at the business level, that kind of stuff from the partnership, that's going to apply to the S corporation as well.
Okay. Well, what are some of the advantages of this? Let's advantages, disadvantages, and just some other overall things that we need to pay attention to when it comes to choosing an S Corp.
Yeah, the advantages are generally going to be the same as with the partnership as far as flow through and some of that kind of stuff. There is one big distinction in that the special allocation thing we talked about is not applicable to S corporations. That's actually a disadvantage of the S corporation. But by and large, the flow-through treatment's the major advantage. The other major advantage that S corporations have that we discussed last time in the single owner podcast is that any income earned by the shareholders above and beyond wages paid to them, it's not going to be subject to payroll taxes. You're not going to pay Social Security or Medicare tax on that income, and that can be a pretty big advantage because in a partnership, you're going to pay. If you're active and working in the partnership, you're going to pay the Medicare tax and Social Security, all the way up to the limit on Social Security, and then there is no limit on the Medicare. So you're going to constantly pay that on all your income. The S corporation, the big advantage is you only pay the payroll taxes on the amount of your wages you receive in the form of a W-2.
Mm-hmm.
Anything above that, just going to be subject to income tax. It's not going to be subject to payroll tax. That's a major advantage of the S corp.
Well, what about sale of stock or dissolution of a S corp, or you're buying a partner out, or not a partner but another person who's a member of the S corp? Help me understand all of that.
Yeah, selling stock in an S corp can be advantageous because you're going to get capital gain treatment on selling the stock, and selling a business and how to structure that from a tax standpoint is an entirely different series of podcasts, right? But generally speaking, if you have a stock sale, you have capital gain treatment. Partnership, you do also, but there's some caveats around unrecognized income like receivables and that kind of stuff that we talked about. So a little more complicated on the partnership side, but that's definitely an advantage of an S corp. So there's a lot of disadvantages with the S corp, that don't really apply, or they do apply when you have a sole owner, but as you get more than one owner in the S corporation, it starts to get more complicated. Some of these disadvantages become a little more glaring, and we need to pay a little more attention to them. And one of the big ones really is around the special allocations of income. Any income earned by the S corporation above and beyond the wages paid to the owners. The advantage there, again, is you're not subject to the payroll taxes. The disadvantage is we can't do any special allocations on that income. IRS says we got to split that on a per share, per day basis for the shares owned. That's complicated a little bit when you have people entering and exiting the S corporation throughout the year. But if you have the same ownership throughout the year, then it basically just means, if you and I have our widget business and we own it 70-30, you own 70, I own 30, we have to allocate all that income, 70% to you, 30% to me. We can't do anything different, right? And the only way to really equalize or to do any sort of, quote unquote special allocations is through additional payroll. So maybe I'm putting in more work than you are because you're kind of semi-retired, but you have 70%. So we want to get us to equal income for the year on the 50-50, right? Well, we got to pay me more wages than you, and then you're going to have the 70% of what's left over and the 30%, and we kind of find that break-even point where we're basically 50-50. But now we've negated some of that advantage to me on saving on the payroll taxes because my wages are now higher.
Right. Okay.
So you can't really specially allocate the S corporation income. It has to be just a per share, per day basis, and we're just stuck with that. So that's definitely a disadvantage, of the S corporation.
Sure. Okay. And you might have said this, and I'm sorry, but I'd like you to repeat it if you did. But what happens if there's massive profit, right? So, how do you flow the profit through to the owners of the S corp? Is that all done through stock, dividends? Help me with that.
Well, first, it's what we call a good problem to have.
Yeah, it's an awesome problem, right? Please understand, if this is another topic that we need to dive a lot deeper into on another podcast, that would be great. But if you could just give us a 30,000-foot view, that'd be awesome.
So, it's a good problem to have, obviously, having all these profits, but getting the money out's pretty easy in an S corporation and a partnership. Remember, they're a pass-through entity, so all the income earned in the business is going to be taxed to the owners in the year the income is earned, even if you retain that cash inside the business. So year one, we have a huge profit. Matt, you got 70% of the income. I have 30%. We have to pay tax on that on our personal tax returns, even if we left all the cash inside the business. Year two, if we want to take money out to help pay for the tax on April 15th, we can do that. We've already recognized the income from year one, so there's no extra tax impact in getting the cash out. So that's the 30,000-foot view you asked about, is you can pull the money out whenever you want as long as you've already recognized the income from the business.
Okay, awesome. All right, so we've talked about some of the advantages and some of the disadvantages. What else is there that we need to know about an S corp before we move to, I think, what a lot of listeners are going to be very interested in, which is what really is a C corp politically? Taxation on C corporations and corporations is kind of a hot button issue right now. We're knee deep in tax season. So what are we missing with S corp? And then let's move on to the C corp.
The last few things on S corp, the fringe benefit stuff we talked about with partnerships where you can't really take advantage of that when you're an owner. Those apply to an S corp as well whenever you have more than 2% of the shares. So generally speaking, that's most S corp shareholders, unless you have a bunch of them in a bigger S corporation. So you have the disadvantage on the fringe benefit stuff there, and then on termination of an S corporation, that's going to be more complicated than getting out of a partnership if you want to get the assets out. And that's why we kind of have a golden rule on thou shalt not hold real estate inside of a corporation, because that's a classic one where any asset coming out of a corporation, S corporation or C corporation, has to come out at current value. And if that's higher than the cost or the tax basis, you're going to trigger a gain. So that can be huge problem if you have a substantially appreciated asset inside the business. So generally for an S corp, you don't want to have a lot of property that's going to appreciate and that kind of stuff, because you can't get it out without triggering tax. So you're stuck with it for a long time,
okay,
or forever potentially. So if that's going to be one of the things you're going to be holding in your business, we tend to rule out the C and S corp right off the bat with that, right? So that's why
the partnership would be.
Yeah.
Right. And that's why what you were saying before, which is one of the reasons why a lot of real estate transactions are partnerships, is because it's just a lot easier to move that stuff around, right?
That's exactly right.
Wonderful. All right. Well, if I had the dum-da-da-dum music, I would play it right now, but I don't. Let's talk about the C Corp. So you've gone through and you've decided after your process of discovery that a partnership's not for you. An S Corp just isn't exactly right. How do we arrive at becoming a C Corp?
So a C Corp is just a corporation where you have not made the S election to be a S corporation, or it's a former S corporation that you decide to revoke your election, or it gets terminated inadvertently and ends up becoming a C corporation. So a C corporation is, again, a corporation, except this time, unlike the flow-through treatment that we have on partnerships and S corporations, a C corporation is its own taxable entity, and it will pay its own income tax at the corporate level. And then talking about those distributions and getting money out to the owners when there's a lot of profits, like we talked about with the S corp, that's more difficult in the C corporation, because you can only take it out through wages for employees, or through dividends to the owners, or to loans, which must be paid back. So if you're going to take it out as a dividend, you're going to pay tax again at the personal level on that distribution received. And that's why you hear a lot about double taxation at the corporate world. That's what that is. The corporation's already paid tax on all that money once, and that gets distributed as a dividend, and then everyone that gets a dividend pays tax again on that money. So that's double taxation. That's the major negative about the C corporation, is the whole double taxation thing.
Gotcha. Okay. One of the things that you have here in the notes is that many venture capital companies use the C Corp. And I know where you're located, there's a lot of venture capital, and I know you have a lot of venture capital clients. Why is it that a C Corp is the preferred choice of entity?
C Corp preferred for a lot of reasons. Primarily, if you're going to be an investor in a lot of different small businesses, your taxes can become a nightmare really quickly if every single one of those is a flow-through entity, and you had to wait to get all that information to flow down to report on your personal tax return. And it'd be very hard to do any sort of tax planning or be tax efficient at the personal level with that much flow-through activity going on. So, as VCs, they make a lot of bets, right, in the hopes of getting the home run. So they don't want to have to deal with any of the flow-through tax consequence on these businesses, for them or for any of their limited partners in their venture funds. So the C corporation is definitely a preferred thing there, even though they do pay their own share of tax. But, the double tax thing isn't that big of a deal if you're retaining profits inside the business to grow it. And that's because the top marginal corporate rate right now, 35%, is actually less than the top personal tax rate of 39.6%. So you're actually a little better off if you're making a lot of profits and you're going to keep it all in the business to just be a C corporation, pay the slightly lower tax rate, and then, build up your retained earnings in the business for expansion and growth and acquisitions and that sort of thing.
Okay. Well, there's
another advantage of the
go ahead.
C corp the VC guys like too, and there's a rule called qualified small business stock, QSBS for short. Very popular here in the Valley. A lot of startup founders I deal with are familiar with it, or if they aren't, they absolutely should be. And if they don't have a CPA that is, they got to give me a call. But essentially QSBS is a very favorable tax treatment on the sale of your shares in your business, and it only applies to a C corporation. There's some other caveats too. You have to have acquired the stock from the company when it was smaller, so less than 50 million in assets. It's not going to acquire, and it's not going to count if you're an employee of Google now and getting shares, for instance. But if you're a startup founder, it's obviously at the beginning the company's worth zero, so you meet that requirement. And the other big requirement, which can be difficult to meet, is a 5-year holding period on the stock. You have to hold the stock for 5 years. But if you meet that and a few other requirements, it's in a eligible business. Not a service business, but software development counts, and we have a lot of that around here. You can exclude a lot of the gain from tax for federal tax purposes. You can actually exclude up to $10 million of gain, or 10 times the basis of your stock, whichever one's higher, right?
Wow.
So generally it's the $10 million rule. And, the rule, the percent you can exclude has changed over time. It used to be 50% was excludable. But since they started since they changed the laws around 2010, I believe, any stock you've acquired after September of 2010, you're going to get 100% exclusion on that up to $10 million of gain. So that's zero federal tax on a liquidity event, on a cash out for the first $10 million of gain. And at current tax rates, it's actually $2.38 million if you meet the requirements. So that's a big tax advantage, and the VCs, they absolutely take advantage of that, if they have a sale. And there's another smaller provision of that QSBS section for rollovers. So if you're going to take some of the proceeds from a qualified small business and you're going to roll that money into a new startup, like you're a serial investor, you can defer the gain on that. And you don't need to have a 5-year holding period there. It's only a 6-month holding period. So a lot of the VCs will do that as well, where they take the money off a win and roll it into a couple new bets, and they defer the gain on that. So a lot of tax advantages, but you have to know about these rules. There's timing associated with the rollover one. You got to do it pretty quickly, 60 days. So there's stuff you have to kind of have in place and have a good strategy, but significant benefits to the C corporation on a sale of the business.
One of the things that you talked about previously was fringe benefits, right? Different things that different sort of entities will allow or disallow when it comes to fringe benefits. How does that apply to a C corp?
This is one of the advantages of a C corp, is that the fringe benefit rules just apply to owners, shareholder employees, the same as they do to regular employees. So there's still going to be highly compensated, employee rules where you can't, have benefits in favor of people that make the most money, that kind of stuff. But there's none of that limitations like there are on the 2% shareholders in an S corporation or on the partners in a partnership. So the rules are more favorable there. And one of the big ones we actually do, and I have a client coming in today, which I'm going to talk to him about it, is if you have your own corporation, right, where you're the sole owner and the only employee, you can get pretty aggressive with your fringe benefits because you're the only one you're offering the benefits to. So you're not as concerned about how much you're paying out, right? So I have a client now, he has a S corporation currently, and so we can't do a lot of the really great fringe benefit stuff with him because he owns the entire S corporation. He owns more than 2%. But we're talking about revoking our S election, right, and actually going backwards into a C corporation. And the advantage there is we can do health reimbursement arrangements, basically, where we can reimburse a lot of the medical costs of the employees in the plan tax-free to them and deducted at the corporate level. So, generally on your personal return, there's all kinds of limitations on deductibility of medical expenses. It has to exceed a certain threshold of your income. It's 10% generally, which is pretty high. So you have to spend a lot on medical to get any benefit, right? But if you own your own corporation and you have the flexibility, and this particular client happens to have a lot of medical recently, we can, convert back to unelect our S status. Basically, we revoke it, go to a C corporation. Now we can do a health reimbursement arrangement, pay the medical costs of the shareholder employee. We're not discriminating in favor of him because there are no other employees. And now we're deducting all that medical expense on his corporate return and reducing his income and, decreasing his overall tax burden when you take a look at all of his entities.
Sure.
So,
Well, you've already touched on one of the biggest concerns or disadvantages of a C Corp, which happens to be the double taxation. But what are some of the other disadvantages of electing this as your choice of entity?
One of the big ones I like to think about is that issue with startup losses in the beginning of a business. If you're going to bootstrap your own business or fund it in the beginning yourself and put up the cash, you're going to have losses, and definitely give it other sources of income yourself. I think it makes sense to start out as one of the pass-through entities because you can actually take advantage of those losses and reduce your income during those startup years. If you're a C corporation, all those losses are going to be stuck inside the C corporation. And if that business ends up not working out and you got to shut it down, you're not going to get those losses until you actually shut down the business, not as they're incurred throughout the years. So all that cash you're putting into the business to fund it, you're seeing no tax benefit to that during the startup years. And that can hurt, right? So being a float-through entity, you have a lot of advantages there where you can deduct those losses up front, save money in your personal taxes, and then if you end up becoming profitable or the business is starting to look viable and there could be a sale, on the horizon in the, multiple year horizon, you can always switch to a C corporation at a later date, right? You can convert entity type, and then you can take advantage of some of the advantages of a C corporation after that point. But the startup losses in the beginning, that's a big one for me. I hate to see them go to waste, so to speak, when they're stuck inside the C corporation.
Right. Well, let's talk about the dissolution or the sale of a C corp. Is that advantageous? Is this a better structure for something that you're going to sell maybe more quickly, or is this something that gets really messy?
I mean, generally it's pretty easy. You can structure a specific deal however you want, but if you have a lot of shareholders and they just want to sell the stock to someone else, it's real simple, and it's just capital gain or loss, right? And that's what's happening in your portfolio when you buy and sell shares like Coca-Cola or Caterpillar or whatever. You're selling your stock to someone else, and you're recognizing a income or loss, a capital gain or loss when that happens. So that's pretty easy. There's special tax rates that are advantageous for capital gains. So, that's an advantage of the C corporation, and that's why a lot of, all the public companies are C corporations. I would say they have to be. But that makes, raising capital easier. It makes selling shares, transferring them easier, all that kind of stuff, because it's just straightforward. Nothing impacts the business in that regard,
That's fair. So over the last two podcasts, we've really covered an enormous amount of territory. We talked about anything that has to do with the sole proprietor, the sole owner. We talked about multiple owners. You even talked a little bit about how you could be basically kind of like a sole owner of an S Corp or a C Corp. So there's some really interesting components on all of this. If anybody has any questions about this, what should they do? Where do they turn?
Go to our website, wheelercpa.com, and we have an Ask Wheeler section there. You can put in your question, you can get an appointment with one of our CPAs, and we'll walk you through, this whole entity choice process. We'll, kind of figure out the particular situation that you're facing. What type of business are you in? Whether you're going to make money in the beginning or expect losses early on, how many owners, how it's going to be structured, how it's going to be funded, all these kind of things. And then we can help you make an informed decision about which entity type is best for you.
Fantastic. Well, please do reach out. This, as a business owner myself and an owner of multiple businesses, this really does get very, very confusing. And having a trusted person in your corner that really does know this stuff, you can just tell by how Matt Wheeler talks about this sort of stuff that he really, truly has a deep grasp and understanding of what you need to do as a business owner, how to elect, and the benefits and the drawbacks to each. So for Matt Wheeler, this is Matt Haller, and thank you very much, and I hope you have a great day.
Thanks, Matt.